In today's video, we're going to talk about something that I think is going to shock a lot of Canadian investors. In my opinion, lower oil prices are really good for Canadian oil stocks. We're going to break down what exactly I mean, where I'm going with this, and why I think that these short-term headwinds are going to turn into long-term tailwinds for this industry. We'll talk about why I am not at all concerned about short-term price action in these companies that I've been buying so aggressively, and where my investment thesis lies when it comes to the Canadian oil and gas industry. Welcome to Golden Arch Investing. My name is Liam. On this channel, we talk about investing in Canada. If that interests you at all, please do like the video and subscribe to the channel. So first and foremost, we got to talk about why exactly it is that I think low oil prices are a good thing for Canadian oil stocks. And we got to talk about what exactly I mean by a low oil price. Specifically, I'm talking right now about the sub $60 worst case scenario oil prices we saw in April of this year and the subsequent sort of mid 60s price range we've seen oil floating in. There's a couple of reasons why this is an important price number and why $60 specifically has been such a battleground for this commodity. And it all comes down to US shale oil. Canada's oil sands operate more or less like a mine. They have massive startup costs, but once you start these big operations up, they are very cheap to run. Part of the reason why in the spring we talked about Canadian Natural Resources having such a low break-even price. And thanks to that, they don't really care about short-term price swings, because in the long run, the average price they gain over time is going to be higher than any worst point. Now, US shale oil operates very differently. It's a lot cheaper to start up, but it also has a much shorter run time. Each well doesn't last as long. There's not quite the same type of resource, and it can't be operated as cheaply because you have to continue to reinvest if you want to maintain or grow production. As such, it looks like the average break-even price of the Permian Basin shale oil is somewhere in the $60 to $65 range. Meaning that as we saw oil prices this year dunk below that number, they got cut all the way down into the 50s, these American companies no longer made profit. And in my opinion, that's a really good thing for Canadian oil stocks. Ironically, however, we saw the prices of Canadian oil companies drop a lot because a lot of the big investors who own these shares aren't interested in the long-term story. They are just there to collect their dividends, and they don't really care where the company goes long-term. But if you, like me, are a retail investor, you've got a nice long time horizon, you can afford to sit on your hands and wait. And that ability is likely to make you a huge amount more money than any of those professional institutional investors who keep trading in and out of these kinds of stocks. Today, I want to talk about two main things. First being why I think that Canada is so uniquely positioned to outlast US shale. Second being why I think the political shift in Canada is so important and why low prices are going to give you the best opportunity to buy in. Let's start with that US shale story. Now, of course, we've talked about this a couple times on the channel, but the core idea is that with US shale oil, you have to keep oil prices at a certain level in order for the industry to keep going. And you need the assets available, the actual oil in the ground available to be drilled. The problem is that all of a sudden this spring, both of those things suddenly became untrue. One of the first warning signs we saw was when Trump first came out with those Liberation Day tariffs. We saw the price of oil tank. Immediately after, we saw OPEC Plus just over the top rope, jump on top, adding on a huge pull forwards of their production increases. Basically saying, hey, we're going to flood the market. Now, first, when that story came out, a lot of the narrative was that it was about cheating, was that these OPEC countries are mad at places like Kazakhstan, places like Iraq, and they did not want to sort of artificially hold themselves back in order to benefit those countries. But I think there's a second story sort of bubbling under the surface here, because I think that these producers saw the same story that I'm seeing right now, that these major oil conglomerates, let's call them, they saw that US shale oil was weaker than it had been at any point in the past. And I think they learned from their mistake back in 2015. The first time that OPEC at the time tried to kill US shale oil, they basically did the same thing. They just suddenly dumped excess oil onto the markets, spiked down the oil price, and they hoped that US shale would die. But at that time, US shale was this magical opportunity for the US to become self-sufficient. There was all of this massive resource conveniently located in places that had infrastructure or that had some, in Texas and the southern United States, all the way up through Ohio. There was a lot of, there's a lot of opportunity there. There's a lot of manufacturing base. They needed the energy. Everything was aligned. The only thing that went out of whack there was the price. And the price short term was going to be held down. Investors figured that if I put my money on the line here, if debt is easily available for these companies at nice low interest rates, then they can just rack up debt, build up their revenues, and then as the oil price climbs, then I'll get my profits. And those investors are mostly right. Most of the major companies that survived through that period of time ended up sort of becoming these major American oil stocks. Right? You saw a lot of them sort of get acquired and bought up and put together. And like every commodity industry, it's a little bit of a hodgepodge of different names. But in the end, the investors in those stocks won. But this time, there are some challenges in the way. Because there have been whispers, just whispers so far, that the Permian Basin, this largest, most important US shale oil basin, is starting to run dry. Now, two telltale signs when oil basins start to run dry. The first is that the oil producers in that area start pulling out more natural gas instead of oil. The ratio of gas versus liquid is very important for these producers. And if they start pulling out more gas, it tends to say that there's less oil available. The second is that they start to drill tier 2 wells, or wells that have higher break-even costs. One of the first people we saw talk about this very publicly was the former CEO of Pioneer, one of these companies that really did build an industry there in the Permian Basin. They were the experts in that area. And he said very famously at the start of this year that he thinks that the shale oil tier 1 assets have a year or two left. And after that, it's going to be all tier 2 and all tier 3. And you might be wondering, well, what's wrong with tier 2 and tier 3? What exactly makes them worse than these tier 1 assets? And essentially, those tier 2 and tier 3 wells have a higher price compared to the amount of resource you're getting out of them. And in that scenario, your break-even price starts to increase, which is where we get to the maybe sneaky genius of that OPEC plus move. Because by flooding the market at that time, when suddenly there's all these question marks about US trade, about the global demand, about whether or not you can invest in any industry, much less being one as debt riddled as American infrastructure and energy, they suddenly spiked down the price of oil dramatically lower than those shale oil producers break even on tier 1 wells, making it just about impossible for them to sell investing capex money in tier 2. And we saw this actually take a tangible effect within Q1 and Q2 earnings, where we saw these companies come out and revise down the amount they were willing to spend on capital expenditures, meaning they were not willing to grow this industry as fast. Keep in mind, US shale oil has been growing at incredible rates over the last little while. I'm talking from just about zero, about a decade ago, to the largest producer on earth now. We're talking millions of barrels a day, increases by the hundreds of thousands or millions of barrels each year. And so when you see those increases start to slow, all of a sudden the question becomes, well, where does the excess demand go? If there was demand for all this US oil, if they stop growing and there's going to be more demand for energy, particularly within the United States, within the Western Bloc, within sort of the areas that the US has served, who are they going to turn to? And a lot of investors have started to look at Canada to solve that problem. The one big disadvantage with Canada, however, is that we don't have the kind of infrastructure that the Americans do. And that's where the second point of this whole argument comes in. Because right now we have this massive shift in Canada towards building new infrastructure. To explain just how impactful this is going to be for Canadian producers, I want to show you guys an article here. It's actually quite old. This is from 2022. It's from the Canadian Energy Center, but it talks about oil prices and them becoming more equal. This is another storyline that I've covered many times on the channel. It's all about the WCS WTI differential. the different price that Canadian producers get significantly discounted to their American peers. And I think that low oil prices are going to squeeze this differential, if not eliminate it entirely, at the same time as Canada invests aggressively in our energy infrastructure. We have seen dozens of promises at this point. I've talked about one actually in the past week where big political statements are made saying we're going to build new pipelines, we're going to build new exports, we're going to build this and that, it'll be great, and Canada will be really strong. But nothing has happened yet. And this is going to show why I think it's really important and why I think having a low oil price right now makes it even better for us as individual investors. Specifically, this talks about Canadian access to global markets, how it's critical. And we saw a sort of part of the story play out when we saw the Trans Mountain Expansion pipeline come online. A lot of these pipelines that this article talks about obviously didn't make it through. Right? They talk about TMX, Keystone XL, Northern Gateway, Energy East. Of those, only one ended up getting built. And they talked about how market diversification will result in Canadian oil fetching higher prices, reducing the discount. Canada's export pipeline expansion is needed for oil producers to meet rising global oil demand. Whoa, that's hard to say, particularly from emerging and developing economies. Additional Canadian export pipeline infrastructure is needed for oil producers and citizens to benefit from rising oil demand. According to the IEA, the International Energy Agency, global crude oil demand is expected to rise from 96.6 million barrels per day to 103 million barrels per day in 2050. We're actually beyond that right this second, so they undershot. But there's going to be continued demand is the spark notes here. Canadian crude oil production has the potential to take advantage of growing demand, mainly because we have so much of it. Again, the big advantage of Canadian oil is that we have a huge, I'm talking like world class, top 5 in the world resource base here. And that we need pipelines in order to export that, right? The demand of our pipelines is continuing to increase. And you see the numbers they release here don't even show the spike upwards that came when we had TMX come online. The export pipeline, so the actual pipelines going to the coast, are even more important thanks in part to U.S. refineries becoming more reliant on Canadian crude. And this is a storyline we have really not covered here in Canada. But think about all of the infrastructure that's been built in the United States. Think about all of those LNG terminals. Think about all of those massive refineries. Some of them already exist to serve Canadian heavy oil. But Canada is not only a heavy oil player. We do have the same kinds of shale assets here in Canada that they have down in the US. And if the Permian is starting to run dry, all of a sudden these shale assets in Canada that offer this huge basin of resource suddenly become an attractive target not only for international markets, but also for those same American companies. And low oil prices benefit us as investors because those American companies are going to become more and more desperate for these resources if they're not able to continue to sort of push their investment in the Permian, in the US basins for the medium term, right? The 2 to 5 year period. If all of a sudden they see that oil prices haven't spiked up, CapEx has slowed, and they no longer have the same kind of growing demand, they need to look elsewhere for somebody to buy their assets. And it's going to have to be Canada. There's no one else positioned as beneficially for these specific assets. Canada is going to be the only option for them. I'm going to sort of zoom out here a little bit. And I want to say that one sort of final idea here. Canadian oil stocks are going to have a fantastic 5 to 10 year run. The big ones are likely to make it the longest in this run. The small ones are likely to get bought earlier. And the lower you see oil prices go short term, the better your opportunity is to own shares. Because while a lot of investors are missing out on this whole story, some of us understand that Canada is in a prime position to benefit from all sorts of massive world-changing events, right? The decline of US shale, the decline or sort of increase, I guess I should say, actually, of hostilities, the decline of relations around the world, the increase in geopolitical tension. All of these storylines are coming together at the same time, and Canada is finally investing in pipelines to bring it not only to international markets, but maybe down to the US, where their refineries are suddenly going to need a new asset base. We have a massive amount of asset here. Canadian companies own huge quantities of oil. We're talking decades of runtime at current production levels and massive room for expansion if infrastructure permits. I've talked a million times about the new pipelines that might get built. I'm not going to do that to you here, but I think that every time you see oil prices drop and you see those comments show up saying, oh man, should have sold my oil stocks. These are such a waste of time. I am losing out. There's an opportunity cost here. I'm losing out. Think about the potential in the longer term. Think about how much these companies are going to become in demand. Think about how high oil prices could go in a world where the 14 billion barrels of US shale aren't there, where you don't have those massive amounts of Permian Basin assets that, have been basically the lifeblood of the, South US, Texas oil industry for a decade. Think about how much opportunity there is there. Think about if that fits your portfolio. That's what I'll have for you folks today. Let me know in the comments below. Do you agree? Do you think that low prices are a good thing for Canadian oil producers? Which producers do you think are going to benefit the most? And of course, if you have any other companies, topics you want us to cover on the channel, please do drop that in the comments. If you like this video, you like what we do here on the channel, please do like it. If you like sort of the videos we produce, please do subscribe. And as always, I hope I see you in our next video.